Hi, I'm Susan, and it's time to break down some policy. Today, we will be breaking down the new Tax Cut and Jobs Act. A version of this bill has already been passed by our House of Representatives and by the Finance Committee. Sometime next week, this version of the bill is slated to be on the Senate floor. The two versions are slightly different, and that means that even if this bill passes the Senate vote, it will still need to go to another committee to be reconciled before it will be passed on to the President. Now, I've heard massively different reactions to this bill, and there's no way to rectify the completely different versions we're hearing from our politicians and news personalities unless we actually read this thing for ourselves. Now, I know it's a tax code. One of the most boring and intricate things for anyone to try to sit down and actually read. But this is actually just the revisions that are being proposed by the GOP. That means it's a lot shorter at only 245 pages, and actually quite a bit easier to read. So instead of expecting that everyone will carve out time this Thanksgiving holiday to read this, I already read it and I'm going to break it down for you today. I will only be hitting the major points to keep this video as short as possible. Individual tax reform. Ready? Yes, you can do this. Deep breath. Here we go. For this first part, we get to use a handy-dandy table. A table very similar to this one can actually be found in the tax bill, but the one I'll be showing you today is modified to include current tax rates for comparison purposes. Just to clarify before we start, I'm sure you heard that this bill would simplify the tax code by reducing the number of tax brackets. This bill does not do that. The version of this bill that went to the House reduced the number of brackets. This bill, for the Senate, only changes the percentages and income ranges for each of the brackets. We're going to start with the proposed changes for single individuals, but it is good to note now that the same percentages for each bracket will stay the same regardless of how you file your income taxes. As you can see, these are the changes that people would see if filing as single individuals, as heads of households, as married individuals filing jointly and surviving spouses, as married individuals filing separate returns, and for estates and trusts. And now we get to the less detailed topics, but no less important. Standard deductions. Currently, the amount for the basic deduction is $6,350, $9,350, or $12,700. Under the new bill, this would increase to $12,000, $18,000, and $24,000. Deductions for personal exemptions. Generally, currently, the amount deductible for each personal exemption is $4,050. Under the new bill, this exemption would be eliminated. Business income for individuals. In general, this income follows It's okay, buddy. And that would probably be a good time to introduce my puppies. Growl at the camera, Mocha.
And here's my TG.
In general, this income follows the same rates we described in our tables at the beginning. However, in the new tax plan, an individual taxpayer generally may deduct 17.4% of domestic qualified business income from a partnership, S corporation, or sole proprietorship. However, this deduction would not apply to specified business services. Those include trade or activity involving the fields of health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of such trade or business is the reputation or skill of its employees. Child tax credit. Currently, an individual may claim a tax credit for each qualifying child under the age of 17 in the amount of $1,000. Under the proposed bill, this credit would increase to $2,000 per child and would extend the age of qualification to 18. The proposal would also provide a $500 non-refundable credit for qualifying dependents other than qualifying children. Deductions and exclusions. Under the current law, deductions are allowed for state, local, and foreign real property taxes, state and local personal property taxes, and state, local, and foreign income, war profits, and excess profits taxes. Under the new proposal, state, local, and foreign property taxes, and state and local sales taxes are only allowed as a deduction when it relates to expenses for the production of income. This therefore would only apply if one is filing a Schedule C, E, or F on their tax return. Otherwise, these deductions would be eliminated. Qualified residence interest is not treated as personal interest and therefore is allowed as an itemized deduction, subject to limitations, of course. The new bill would eliminate this deduction. Generally, a person may claim a deduction for any loss sustained that was not compensated by insurance or anything else. These losses could be from fire, storm, shipwreck, or theft. Under the new bill, these deductions would only be allowed if the loss was incurred in a disaster declared by the President. Under the new bill, individuals would no longer be able to claim tax prep expenses as an itemized deduction either. And now, for miscellaneous stuff. Generally, itemized deductions are allowed for miscellaneous expenses so long as, in aggregate, they exceed 2% of the taxpayer's income. As with most miscellaneous things, there are a lot of applicable expenses. But to give you a taste, this would include things like appraisal fees for a charitable donation, depreciation on home computers or computers that are required for work, loss on traditional or Roth IRAs, union dues and dues to Chamber of Commerce or professional societies for job purposes, home offices, legal fees, licenses and regulatory fees, and malpractice insurance premiums related to work, medical examinations required by an employer, rural mail carriers' vehicle expenses, tools and supplies used in the taxpayer's work, purchase of travel, transportation, meals, entertainment, gifts, and local lodging related to work, work clothes and uniforms, work-related education or educator expenses. The new bill would eliminate these itemized deductions, and so many more, entirely. However, the new bill would increase the percentage limit for charitable contributions from 50 to 60%. Overall, currently, tax law limits most otherwise allowable itemized deduction for certain upper income taxpayers. The proposed bill would repeal this limit and thus allow taxpayers with income over certain thresholds to have unlimited allowable itemized deductions. Next, we have real estate transactions. A taxpayer may exclude up to $250,000 of gain realized on the sale or exchange of a principal residence, so long as it was, in fact, their primary residence for at least 2 of the 5 years prior to the transaction. The proposal is to increase this time requirement to at least 5 of the 8 years prior to the transaction. And quickly, it is noteworthy that this new tax bill would repeal the exclusions for qualified bicycle commuting reimbursement, qualified moving expense reimbursement, and deductions for moving expenses. Okay, 7th inning stretch. We're almost done. Estate and gift tax exemptions. This section is actually pretty long in the proposal. However, most of it is describing what the current law entails for this very, very detailed and intricate section of tax law. But really, all you need to know for the purposes of this proposal is that a gift tax is imposed on certain lifetime transactions, and an estate tax is imposed at certain transfers at death. Generally, a credit is available for these types of transactions. The exemption amount set in 2011 was $5 million. By 2017, inflation has increased that amount to nearly $5.5 million. Basically, what this means is that the estate tax and gift tax won't apply to the estate or gift until the amount involved surpasses that $5 million mark. Anything less than that, generally, does not get taxed at the federal level. The new tax bill simply doubles the exemption amount from $5 million to $10 million. So that means that the federal government will no longer collect taxes on estates or gifts in the amount of $5.5 million to $10 million. An important note regarding the Affordable Care Act. One of the last things that the Senate Committee on Finance decided to include in this proposal is about the Affordable Care Act. Under the proposal, the amount of the individual shared responsibility payment enacted as part of the Affordable Care Act is reduced to zero. The last thing that you need to know about this new tax plan in regards to individual tax returns deals with something called the Alternative Minimum Tax, or AMT for short. The AMT is a supplemental income tax required in addition to baseline income tax for certain individuals, corporations, estates, and trusts that have exemptions or special circumstances allowing for lower payments of standard income tax. The best way to actually explain what this is used for is to look at why it was created. The explanation offered by Congress's staff on the Joint Committee to Internal Revenue Taxation in 1969 stated, and I quote, "The prior treatment imposed no limit on the amount of income which an individual or corporation could exclude from tax as the result of various tax preferences. As a result, there were large variations in the tax burdens placed on individuals or corporations with similar economic incomes, depending upon the size of their preference income. In general, those individual or corporate taxpayers who received the bulk of their income from personal services or manufacturing were taxed at a relatively higher tax rates than others. On the other hand, individuals or corporations which received the bulk of their income from such sources as capital gains or were in a position to benefit from net lease arrangements, from accelerated depreciation on real estate, from percentage depletion, or from other tax-preferred activities tended to pay relatively low rates of tax. In fact, many individuals with high incomes who could benefit from these provisions paid lower effective rates of tax than many individuals with modest incomes. In extreme cases, individuals enjoyed large economic incomes without paying any tax at all. This proposed bill completely eliminates this failsafe for both individuals and corporations. And there you have it. Yay! 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 The proposed Tax Cuts and Jobs Act for the Senate. Again, this is slated to go to the Senate floor for a vote sometime next week, after the Thanksgiving holiday. This is the information that you need to know to make an educated decision for yourself on whether this bill should be passed. Please make sure to contact your senators to voice your opinion. And pat yourself on the back. You just survived a policy break on tax law reform. If you enjoyed this breakdown, please let me know by giving it a thumbs up, subscribing, or leaving a comment. Thank you so much for watching.